Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for November 2nd, 2018. All right, let's get right down to it. The market sees a substantial move back to the upside, followed by some pretty wicked volatility on this Friday. Of course, we're recording here a little after hours on the Friday session. There are 5 very specific points that I want to make to you on this weekend's update. I really don't want to be too backward looking. Let's not even talk about, okay, we rallied up a little bit. Forward looking. We got to look, all right, we're in the midst of some volatility. What do we do now? What can we do now? What should we be doing now? All right, a couple of these points, and then of course we're going to take you over to the charts and get into some more depth. The number one thing that really stands out to me in this coming week is we have an expected move in the SPX of $65. Now, this previous week, we were looking at about an $89 expected move, and we moved every ounce and then some of that $89. So what am I really saying? Okay, this week that we're just coming off of, we moved, again, beyond the $89 expected move. And then right at kind of the last minute here on Friday, we actually curbed right into the expected move, which, again, is a sign of kind of efficiency, if you will, in the marketplace. Nevertheless, the point being, okay, this week that we're just coming off, huge moves inside of the market, obviously to the upside, followed by, as I said, some pretty wicked down move, of course, and a market reversal on Friday, which, by the way, if you guys were tuned in on an intraday basis here at TheoTrade, we caught every ounce of that down move. The reversal was phenomenal for us on an intraday basis. We caught it using some SPY puts. All right, the point of me talking about, though, this $89 expected move is this next week, we only have a $65 expected move. Why does that grab my attention? Well, on the $65 expected move, whoa, back up a second. We're here on Friday, right? It's November 2nd. We just saw that kind of action in the S&Ps today. And you're telling me that all next week, we're not supposed to move more than about 65 bucks, except we did that today. And my point being, again, the implied volatility options market still isn't really depicting all that much risk, yet the historical volatility, which is the actual price movement, has been relatively wild. So this is a stern warning. If you're selling premium in the short duration, you have been warned. You don't necessarily want to be selling premium. Premium sellers, I've been telling you, you're kind of warming up to this idea, right? We're just warming up to maybe selling a little premium. But when we're seeing historical moves exceeding implied volatility, you got yourself an issue. All right, number 2 point that I want to make. We got an employment number that came out today. The employment number, bottom line, it was good. Strong employment number. They actually bumped the, obviously the 3.1%, which was the pay. Saw an increase that's actually one of the best increases we've seen in quite some time. The bottom line with everything involving the employment situation is that it leads us to believe that there's going to be continued rate hikes in December. Continued rate hikes is the equivalency of saying interest rates are going to fly up, which the market has not reacted positively to, right? In fact, today, bonds sold off. Bonds selling off is indicative, of course, of interest rates going up. It didn't exactly bode well for the marketplace, and it's probably why the marketplace effectively reversed. All right, next thing we're going to talk about. In a rising kind of interest rate environment, really, what strikes your fancy out there? We got to look to short, at this point, extraordinarily strong sectors. Now, I'm going to come to that notion here in just a moment. We want to look to short strong sectors. Why? Why short strong sectors? Bottom line, correlation. We believe that if we're going to see continued volatility in this marketplace, the marketplace is going to have a very, very heavy correlation. What that effectively means, if you're in the S&P 100, you're going to move with the S&P. So if the S&P is moving down, doesn't matter where you go, where you hide, strong sector or not, it's going to get whacked the next time the marketplace sees a degree of correlation and a degree of course, volatility. All right, so we got that out of the way. So we're looking again, expected move doesn't look large enough. Number 2 point, employment situation equals what? The Fed probably raising rates in December, market doesn't like it. Number 3, short the strong sectors. Number 4, okay? Number 4 has a lot to do with guidance. Listen very carefully to Apple and Amazon. Both of them, they didn't guide like really negatively, but Apple and Amazon both said, okay, holiday season might not look that rosy. And yet, okay? And yet, if you look at some of the retail stocks out there, they're uninhibited by this. So just a moment ago, I said, short some strong sectors. Guess what? I know where to find some strong sectors. Retail has been ripping to the upside. Why is retail ripping to the upside? Are they not listening to what Amazon and Apple are saying? They're saying the holiday season might not necessarily be as spectacular, okay, as the market's pricing in. So we're going to look a moment at the charts. Maybe we can actually short some retailers. Last but not least, okay, the fifth point over here, psychology of the marketplace has got everybody twisted around right now. Listen, we've told you time and again in the last couple of weeks, we are in this volatility, okay? Love it or leave it, we are in this volatility right now. And the rallies are going to be wicked to the upside. You should expect that, right? The rally to the upside this week, it's there. It's like everybody has to bite. And when everybody bites on the rally, like they're like, this could be a buy the dip, I could be missing out. And the second that we get to that notion again, they're going to whack them. All right, this is exactly what I believe is going to continue to go on for a substantial period of time. Volatility, the easy part of it, it's over. Okay, now you're going to have to step up there. You're going to have to short on the wicked rallies. You're going to have to wait for unbelievable sell-offs if you're going to sell any put spreads. Again, when we're flying to the upside, you should be selling out of the money call spreads. We did that in Amazon this week. When we're getting crushed and you feel like there's not going to be a tomorrow, you look for beaten down sectors and we sell some put spreads in there. Welcome, again, welcome to some volatility. But we're going to take a much deeper look here momentarily at a couple of charts. And we're going to get into details because we're talking about some premium selling, okay? Premium selling, though, in the general S&P looks very, very leery. However, some premium selling opportunities are really starting to open up a bit more in individual equities. With that, let's get to it. Let's take a look at a couple of the charts.
All right, so let's get to the charts. We're going to start on the SPX and get into some details specifically about the expected moves, both from this last week of trade. And of course, as I said, I want to be extraordinarily forward kind of focused on this video. So in the previous week, the expected move, and right here, you can actually see this is the start point of last week. This is the upper band, okay, and the lower band. And that expected move last week was right around $89. So what the option market was saying is we should move about $89 higher or lower. And the point of me bringing this up from last week is that there was actually a breach to the upside this morning. So that was Friday morning. Friday morning, we explode, of course, to the upside, only to see, again, as I called it, this kind of wicked reversal in the marketplace. I woke up this morning, the S&P futures, I mean, the S&P futures were up, 25 plus points in the morning. Now, this next week of trade, what are we really looking at in terms of an expected move? It's plus or minus about $65. Now, if you're a little bit new to this business, you're like, well, where does he get these expected moves from? It's just the option chain. That's it. Okay. Here, we'll tighten up the option chain right now and just take you over and just highlight it real quick. Okay, you're looking right there. It's about a $65 and change expected move. Now, why does this kind of strike my fancy, as I was talking about a moment ago? Listen, if you're not paying attention to this, you're missing a much bigger picture. If you're buying option premium, if you're selling option premium, you need to pay attention to this. And, I'm only going to have to say this like one time. Listen, the entire next week of trade, right? You got a full week of trade ahead of you. I kind of boxed it out. It's looking for, again, as I said, it's $65, right? But it's not $65 total. It's $65 higher, okay, or $65 lower. Now, hold everything right there, okay? So $65 move. Go look at the S&P futures today, okay? The S&P futures. Hey, what was their movement? This is today, right? Well, it looks like the high was 2766 and the low was, let's just call it 2700. All right, so let's cut to the chase over here. The expected move for the entire next week, $65 higher or lower. Yeah, but we achieved that today. And that is some wild stuff. And I'm telling you, if you're a premium seller, you still have to avoid a little bit in the SPX. The index products themselves, are seeing, and I was talking about like historical versus implied. Here's the bottom line with all of that, okay? The index products, they're moving more than the options market is depicting them to be capable of moving. If that makes sense, all I'm saying is, hey, this next week, we're only supposed to move $65. but we're very capable of moving substantially more than that, clearly, since we did it effectively in one day. The other aspect you can look at, if you cruise over to the SPX and close this up, okay, and we'll just kind of continue there, but if you cruise that over and close everything up, go down to the bottom over here, and you'll see the IV percentile, okay? The percentile is like 30 percentile, which effectively means we're not in that high of a range of implied volatility. I've also got a style for this to kind of display to you. All right, so look at IV rank and so forth and percentile. You can see the implied volatility, it's come down. I mean, listen, the IV, it's still up there, but it's contracted to a degree already, and it just doesn't necessarily look worth all that while. Meanwhile, if you look at something like Amazon, we're going to cruise over to Amazon for just a second. Again, we're going to, cut to the chase and talk about some trades here. If I load that exact same style up on Amazon, Amazon is in a much, much higher volatility situation. So some of the equity products are begging you, sell me, sell some premium on them. And the index products are saying quite the opposing. And it's a big catch-22, because with one hand, I'm telling you, don't sell premium. The other hand is saying, fire at will. And in Amazon, I did. Okay. And I actually, I shorted an Amazon spread, and I actually sold call spread in Amazon. So I sold a call spread right out in this neighborhood right here. Guess what? I did that in the midst, okay, of a Thursday rally. And boy, it was a big rally to the upside. But, the way I say, you have to step in front of the freight train. You're not willing to do that, you're never going to be able to deal with some volatility. That's what volatility is about. And sometimes, stepping away in the freight train, it's just a matter of comfortability inside of the marketplace. Now, cruising back over to the SPX, as I'm saying, we're still expecting, obviously, some fairly substantial moves inside of the S&Ps beyond, I would believe, this $65 move. Okay, the other thing I want to talk about before I move on, okay, to a couple other points here, are these levels. So we're actually going to snap this. This is a 30-day 1-hour chart. Let me close up the left side bar. 30-day 1-hour chart. If you're not paying attention to the levels that we've been talking at nauseum, okay, you're missing the bigger picture. All right, we were skirting right along this 2731. Okay, we exploded off of it in the middle of the night, came back, touched back down into it, headed right again back to the downside, and our final resting place this week is just shy of that 2731. Keep an eye on what we term these gravity points throughout the course of the week. They have been, people, I'm telling you, spot on. That's 2731. Okay, you think that isn't an effective spot in here? This is a spot that we've actually had since all the way back to the January time frame on our chart. Now, what I would anticipate, okay, is eventually, all right, after a little bit more chop, and again, all that we're going to see right now in terms of this volatility is just trading from level, okay, to effective level in some of this kind of chopped out trade, which is really good, in my opinion, on an intraday basis. The first time we've had some two-sided trade in quite some time. Eventually, we are going to make a crack, and we're going to go below the 25.75. Again, I do not have any levels below 25.75. Talked about this on a video a couple of days ago, but hey, the bottom line is we just haven't traded down there. And these lines, these gravity points, okay, this is all regression analysis. This has nothing to do with this isn't a Fibonacci. This is not it's a sacred beast of a number. It has nothing to do with any of that. Everything to do with exploring where institutional order flow kind of rests and where their delta levels happen to effectively be. Obviously, 2731 is kind of the happy place of trade. You see something really wild, though. If we start to crest all the way down to 25.75, okay, it is on at that point. And at this point in time, I will throw a little opinion out there. We are more than primed to test and exceed the lows that were achieved in early February. So I wanted to get to the levels and cut to the chase right away. Why? Well, the second point that I made over here was about interest rates. Okay, if you're not paying attention to interest rates, that's the big picture. All right, what sparked most of the volatility? What sparked volatility, right, started in August. Here's the bonds selling off in August. And as the bonds started to sell off in August, okay, eventually people stepped up to the plate. They waited till October. They're like, wait, this whole bond thing is starting to get scary. And yet the bonds were declining for a substantial period of time. Well, guess what? Okay. You have to look at the marketplace. It's like a house of horrors and stuff comes back to like haunt you. Well, here come interest rates again. Interest rates right now are caught pretty wicked downtrend. The only thing that's going to pull interest rates back up in this next week is if the market really got socked hard. Like if the S&Ps were selling off huge, yeah, maybe the bonds are going to come up. But we're in a very ugly situation right now where once again, we can see the bonds start to slip. If the bonds start to slip, the S&Ps, okay, can actually start to bleed out a little bit. And that's a serious situation. Again, the bonds, they took it on the chin today. And this has everything to do with the employment situation. Remember this, good news for the economy is now bad news for the market. Why? Raising the interest rates, and they're not going to take the foot off the accelerator. So think about that. The third point that I was making was short, strong sectors for correlation to kind of kick in. When I talk about correlation, right, there's a lot of things you can use for correlation. One of them I look at is right here in the S&P 100. Listen, the correlations, okay, today, not that strong. You know, the S&Ps actually sold off. The Nasdaq got whacked. Predominantly, that was Apple's earnings, but neither here nor there. The correlations aren't exactly rocking. This is the S&P 100. You've only got 63 stocks down with the S&Ps off by 15 and the Nasdaq off by 100. That doesn't bode well for the marketplace. But here's the bottom line. When the market starts to correlate, and what does that really mean? Okay, when you start seeing, for example, again, 90 products, like 90 products to the downside, everything is going to get whacked at the exact same time, which brings me right to the next point I was making. Apple, okay, and Amazon, they gave guidance that wasn't that good, and both of them mentioned in the conference calls that it had to do with some of the holiday season. Well, that makes sense for Apple because they released the new phone, okay, in the most recent quarter. So coming into the fourth quarter, the phone sales might not necessarily be as strong. It makes sense. But Amazon actually really kind of struck me like, wait a second. Amazon's guiding like the sales might not be so good. In the backdrop of this, okay, you have stuff like XRT. XRT is the retail. It's actually been bid up, okay, unaffected by it. It's almost like everybody closed their eyes to the idea like, no, we didn't hear the retailers are going to not maybe do so good. Listen, Amazon specifically said their sales might not be that great into the holiday season. No, we're retail. We don't care. And they closed their eyes and ears apparently to that one. I'm not saying that the XRT is necessarily the way to go. The XRT has already been whacked pretty hard. I think you have to get really specific over here, okay? Walmart. Now, Walmart's only up 2% though on a year to date. So I want you to start looking at some retail, okay? These are big box stores, retail, whatever it takes. But Target's up right now 5% on a year to date basis. We start to open up the chart for a longer period of time. They're still up about 10% over the last 3 years. Okay. Other underlyings that are really starting to strike me as a little overdone in the short term. I was looking at stuff like Macys. Okay. Macys. Why? What? You think JCPenney and Sears? Okay. All their business is then going to go over to Macys. JCPenney and Sears never even had any business. Both of them are effectively like dead in the marketplace. Nevertheless, Macys, 35% on a year-to-date basis. Think about it. A deep in the money put, okay, short position, even before the earnings. I've actually been bidding for this for a couple of days. I have not filled. Another one that you might want to look at, okay, Nordstrom's. Nordstrom's also exploding to the upside, up 35%. Again, if retail isn't going to look that good in the holiday season, and again, I know that we're talking about Amazon. I know that we're comparing it to Apple. But if Apple and Amazon saying that the retail sales might not be that great, okay, don't tell me that, oh, well, everybody just decided to go back to the mall, because I'm not believing that story. Okay, I think these sectors were oversold and it was just a rotation and they're going to get whacked again. Look to Macys, look to Nordstrom's for short positions. Last, but definitely not least, okay, psychology. All right, there's a big psychology, discussion that people often have. I don't get into it. I just don't get into it. I don't really get into the psychology of the marketplace. Here's the bottom line. Okay, we're in the midst of some volatility. Big damage was done. If you're a market technician, you would have to agree, right? All the market technicians are like, nah, damage is done. Could we rally back up? You better believe it. I think we could actually rally back up substantially. I don't mind saying that. Look, I'm a bear and we could rally back up over here. Those rallies are going to be met now, okay, with some sell side activity. Contraction of the balance sheet, rates are going to continue to go up. Okay. I don't necessarily care about trade war with China. Put it aside for right now. Get it out of your head. Bottom line is, okay, the marketplace is going to go through prolonged periods of volatility. And one thing that we're actually finding out in the midst of this volatility is that, those that are trading via algorithms are getting their heads absolutely taken off right now. If you guys haven't heard that, a bunch of hedge funds that are admitting they're like, well, we've been trading these momentum strategies, and they got their heads lopped off in the month of October. So all of a sudden, instinct and being an actual trader is starting to make sense again. And some of that, again, comes into the psychology of the marketplace. You got to step in the way of some freight trains, okay, to make things work. What that effectively means is, listen, you look at a product like the spiders, okay? This is just a wild rally throughout the course of the week. You don't know exactly when the rallies are going to end. That's okay. You still have to step in and recognize that, give yourself enough time, right? Enough time, and use a defined risk strategy. Use a spread. Step in, okay? Take the risk. You don't have to, I'm not saying put all your chips in the way of a freight trade, okay? Because listen, this is some wild sell side. The bounce back up is going to be vicious, and you know it's going to be vicious. But at some point in the bounce, in the most wicked portion of the bounce, step in. Get short. You can use in-out spreads. You can sell out of the money call spreads. It's a party. Don't dare buy puts or calls. Don't just go out and buy a put or a call. You will lose money. The volatility is just too high. It's just too high right now to get away. You can't afford to make the most simplistic mistake in here, all right? Use spreads, mitigate the volatility risk. I mean, look at something like the financials, all right? The bounce in the financials, but check this out in the reversal of them. We caught every ounce of the downside. We used the financials today, okay? And the financials reversing, the financials are what basically tipped me off, get short the spiders. Okay, and we caught every ounce of this move to the downside inside of the spiders. Not to mention, at the exact same time, I went out, okay, and we purchased in-out put spreads in the emerging markets. Okay, we put on some size in the emerging markets today. And why did we effectively do that? Because, look, I'm 35 days out. I used an in-out spread. The market already reversed a little bit in here. Okay, we did it in the Qs on Thursday. Okay? You got to step in, again, in the face of adversity. So we shorted in the Qs. We shorted in the emerging markets. We shorted in Amazon, okay, by selling an out-of-the-money spread. Okay, in fact, we sold way out of the money spread that's not that far out of the money because the market rallied up a little bit. So we stepped in and we shorted. Again, I don't speak by showing you something in a chart. I speak by executing these trades. And that is what is going to be needed in this marketplace. And that's as far as I will get into the psychology of this market. Stay tuned. It's going to be, again, another wild week inside of the markets. If you guys haven't figured this out yet, I like it. We're getting some two-sided trade. This is, hey, listen, the last 3-4 weeks made my entire year. That's where you want to be. Tune in. Shoot us an email anytime here at TheoTrade. Have a wonderful weekend. Bye-bye.